All right, hi everybody. Thanks for being with us this afternoon. Good to be with you all virtually, and eager to get into some of the market news of the day and the last few weeks and portfolio positioning and all that stuff. I'll get into the formal introduction, but just to remind folks, there's a Q&A box at the bottom of the screen, right in the middle of your navigation bar. Feel free to click on that, type in some Q&A as we go along here and talk through stuff. And if I'm good at my job today, we'll try to interweave some of those questions real time with some of the topics as we're discussing them, and then of course we'll get to some toward the end as well. So thanks again for spending a little bit of time with us this afternoon, and we'll get going here. As I said, this is our first quarter 2025 market review and outlook webcast. My name is Michael Muscio. I'm the president of FBB Capital, and I'm joined today, as always, by my colleague Mike Bailey, who's our director of research and chair of the investment committee. Working behind the scenes with the technology is our teammate Katie Bugley, who's with us. And today we will review the first quarter of 2025 thus far. We bumped the timeline of this up a little bit from when we normally do it, given the recent market volatility over the last few weeks. I mentioned we'll have some Q&A at the end, but definitely use that box at the bottom of the screen. A couple of housekeeping items. You'll note that while you can see us and hear us, as this is a Zoom webcast, all attendees will remain in an anonymous view only mode. However, as I said, we expect you to engage with the Q&A. We'll try to answer all questions today. To the extent that some questions are similar, I'm going to do my best to aggregate those questions in the interest of time, so we try to get through all topics that people have an interest in. I'll introduce each question as it comes, and referring to the first name of the questioner, if provided, and either Mike or I will tackle that. As we begin today's discussion, let me remind you of the fact that today's commentary is based on the facts as we see them today, which of course are ever changing. This next part is just for where we are right now. In periods of increased volatility, like we have seen in the past couple of weeks, investors are operating in what traders call fast markets, and daily and weekly fluctuations can be as volatile, sometimes even more so, than the changing inputs that are ostensibly driving them, be they policy trial balloons or economic data points. So things change, and they can change fast. Please note, any reproduction or transcription of statements made during the call today without our prior approval is prohibited. Should you know someone who would like to listen in, this should be posted up on the website either later this evening or first thing tomorrow. Please also note all forward-looking statements made during the call are subject to risk and uncertainty that could cause actual results to differ materially from what the expectations are that we outline here today. Finally, please review our complete compliance statement and disclaimer at the end of this webcast. All right, with all that out of the way, Mike, let's turn it over to you and take it away, please.
All right, sounds great. Thanks a lot, Mike. So today we're going to be taking a look at some of the macro and micro pressures that have driven a market correction, but which could create some opportunities for long-term investors. We'll also spend some time on how we're positioning amid a backdrop of rising uncertainty, and then we'll wrap up with your questions. Next slide, please. We just mentioned a market correction, which generally means about a 10% decline in stocks, including the one we saw just last week. But what's driving the move lower this year? Our sense is rising policy and economic uncertainty have collided with market expectations, which have been building for the last couple of years, and that's producing some of the downside that we're seeing now. So with that as a quick introduction, let's unpack what's going on with these three weaknesses. Next slide, please. Okay, so if we use this market reaction we've seen as an indicator, our sense is investors are increasingly concerned and perhaps confused by a wave of policies coming out of the new administration. Starting with geopolitics, we've seen the headlines coming out of the Middle East and Russia and Ukraine as very concerning. However, we generally view these types of risks as worth monitoring, although historically we've seen less of a long-term impact on equities. However, tariffs could be another story. As we're looking at a set of unfolding tariffs and threats of countermeasures from trading partners, we can lay out a couple of different scenarios for what's next. In a downside case, rising trade barriers are bad for U.S. companies. They hurt consumers through higher prices. That's certainly concerning. However, there could be an alternative, sort of a neutral or upside case. We can look at the experience of the economy and markets in the last round of trade conflicts in 2017 to 19, the sense that both the economy can adapt and grow, while stocks continue to generate total returns. Okay, so finally, the new administration's approach to cutting government spending through layoffs could also have an impact on the economy and markets, especially in the short term as people lose incomes and spend less on goods and services. Given our location here in the greater Washington area with a high percentage of federal workers, our families, neighbors, and clients are definitely feeling the pressure of these layoffs. With that, I'll turn it over to Mike Nucio to get into some additional details on the next slide.
Thanks, Mike. Yeah, so the moving from the global map and the macro outlook to a little bit more micro, I thought I'd just share some statistics and some data around like what's happening here locally, where most of our clients, if they don't live here full time, most of FPB's clients typically begin from here, begin from somebody who lives here who's referred us to them. So there's a lot of impact. We're having a lot of discussions around planning with folks who are maybe impacted directly and currently still working with the federal government or federal contractors. A lot of folks who have worked with either of those entities or types of entities over their course of their working lives and collecting some type of retirement benefits and whatnot as well. So undeniable concentration of federal jobs in the DMV is higher than anywhere else in the country. You would expect that. This is the home of the federal government, but 20% is the figure. So that equates to somewhere upward of 400,000 plus local jobs in Virginia, DC, and Maryland. And then by some estimates, the federal government contracting jobs are about a 2-to-1 ratio to the all federal workers. So you start doing some additive math there of these things, and you start to get to pretty significant numbers when you consider that the population here that is DMV is around 6.5 million folks. And these percentages start to look pretty meaningful in terms of the working age population. And again, a lot of clients that we work with who are still in those positions, and rightfully so. I think working age folks are concerned about job loss and pension eligibility requirements, things of this nature. And we're having a lot of planning discussions with those clients, as you can imagine. There's also concerns on the retiree front, which are certainly not unfounded, around folks who are either collecting from the old system, which is Scissors or FERS, CSRS or FERS, or even just Social Security and Medicare. I do think we believe that while the concerns here are understandable, the likelihood of cuts to these types of programs are much more unlikely to actually materialize. Benefits associated with these programs, which are predicated on some type of contract in terms of payout to a system that you paid into, be that Medicare, Social Security, et cetera, very unlikely to have cuts in terms of folks that are already collecting benefits. Doesn't mean, I want to be clear, that the concerns about that are unfounded. In fact, it's quite understandable with everything that's going on, but nothing that in our planning that we today are dramatically reducing benefits because of some big cut to Social Security or to your FERS pension or something like that. I will say that there is precedent for cost of living adjustments to some of these types of things being reviewed and assessed during periods of reform. So that could be something that may be on the table. But it would seem that DOGE has their hands full with lots of other things prior to these items. Nonetheless, given that we are a wealth management firm, as you can imagine, these are the discussions that we're spending a lot of time on. So I thought just pausing there for a minute and spending a second there would be helpful. I hope it was. And in the Q&A, we can get into that a little bit deeper if folks would like. So thanks, Mike.
Thanks, and appreciate you going a little bit deeper in terms of some of the changes that we're seeing in policies across the country, but also locally. So as we transition from policies back to the economy, we just heard this afternoon that the Federal Reserve is seeing greater uncertainty for both the job market and inflation. So with that, that in mind, let's start with inflation, where we are still seeing price increases around 3% a year. That is ahead of what the Federal Reserve is looking for of around 2%. And so we'll be tracking any changes there, in particular from tariffs. If that shows up sort of in the purple section of this chart, that's sort of where goods prices would be reflected. Although also on that note, Jay Powell at the Fed made a comment today that if there are increases in inflation from tariffs, Jay Powell sees that as being short-lived. We'll see how that plays out. Additionally, we're also watching the housing market. There's potential for housing prices and expenses to come down over time. That could reduce sort of the yellow section of this chart and bring inflation down a little bit. But we've been waiting for some time there. So lots of moving parts on inflation. With that, let's turn to the other major driver of the economy and the job market. Next slide, please. So we've highlighted some potential impacts to the economy from new policies that could cut back on the number of workers. Now, investors and decision makers are grappling with what's next. If prices remain stable but unemployment spikes, we could have a recession. And in a more difficult situation, we could have another bout of price increases from tariffs, let's say. At the same time, workers are losing their incomes. This could raise fears of a 1970s style stagflation. Now, the Fed's comments today do suggest both inflation and unemployment could creep higher. History would suggest that sharp increases in both unemployment and inflation are less likely, so something worth watching. However, Jay Powell and the Fed are evaluating odds of these scenarios playing out as they consider whether they should slow down the economy with interest rate hikes or try to speed things up with rate cuts. So as we try to understand what's next for the economy and markets, I'll turn it back to Mike Moose here to discuss some implications of some recent economic and investor surveys. Mike?
Yeah, great. Thanks, Mike. So the headlines that most of us would have been reading over the last couple of weeks are generally not positive in terms of the economy. Most of that, and I'm talking specifically about the economy, not potential impacts of the economy related to policy. So two kind of different things. But those headlines are driven by surveys, right? And that's kind of soft data. And so here's a few of those surveys, and just in the last week, I just pulled this up from it within the last week. So University of Michigan, which being an Ohio State guy, that's tough for me to say, but University of Michigan Consumer Sentiment Index fell well below expectations with back-to-back monthly declines for both February and March, for a total of 20% decline in consumer sentiment. Consumer, makes up a big part of the economy. Consumer spending a big part of GDP. U.S. NFIB Small Business Optimism Index has also dropped for the second straight month in a row. And the American Association of Individual Investors bearish responses to the survey hit the highest level in the last year of 60%. If you actually look at the level, 60%, the last time it was really that high was in, I think, October of 23 or 22, and then prior to that in 2020. So very bearish, type of sentiment from individual investors. So this is what the headlines are based on, is the sentiment. And I think, Katie, if we go to the next slide, I did not know that Chairman Powell was going to spend part of his press briefing an hour ago on soft versus hard data. So he did. You can go. It's online. You can go watch that. But we were prepared to talk about it just in terms of what that means. So it's just soft data, or these surveys like that we just went over, where consumers or individuals are saying how they feel about something, and then the data, the hard data, is what are they actually doing. And in fact, having watched the press conference, what Chair Powell said was, if somebody says, I feel really, really crappy about the economy, and then they go out and they buy a car, right? So like saying versus doing. And so this gives you the read on that sentiment survey from the university up north that's down 20% over the last 2 months. So you can see where that is. And then Katie, if we toggle to the next slide, I think we can see, versus same store comparable sales growth at a store like Walmart, in terms of what's actually occurred, right? Now, growth is slowing. Outlook from some of these companies, and we're going to talk about that in a minute, are a little bit worse, or a little bit, or they're projecting not as much growth going forward. But this is kind of one indication where, saying and how I feel versus how I act or what my consumer behavior is a little bit different. A better real-time read on this. CEO of Bank of America said that credit card sales, total card sales for the first 10 weeks of the year are actually up 6% year over year. Now, could it be that people are spending less on some of the things that they were last year, like travel and leisure and restaurant spending and things like that? Absolutely, it could be. But in the total number, the gross number is actually higher, 6% from a year ago still. So I think some of that other stuff, government policy is definitely bleeding into the sentiment. Will the hard data catch up? We'll see. Mike, do you want to go on the manufacturing side, just the differential between the consumer for me, please?
Absolutely. So, what we've seen on the consumer side is some inconsistency with consumers saying they don't feel great, but then they're going and buying stuff. The question is, what about the rest of the economy, in particular for manufacturing? So we get the same thing. We get surveys. How are manufacturers feeling? And then also, what are they doing? We get the results out there. This one is actually a little bit more consistent. So you can see the kind of bottom white line there, the arrows going up. Companies are feeling better, a little bit better about manufacturing volumes. Not great, but just a little bit better. And then production, sort of the light blue line, it's ticked up a little bit. So in general, manufacturers are seeing things a little bit better. We don't want to say, coast is clear, things are fine here. There's a little bit of a backstory where some manufacturers are trying to get ahead of tariff barriers by manufacturing a little bit more upfront. So it's going to take a few more months for this to play out. However, in the short term, we are seeing big companies continue to manufacture at a pretty steady rate, a little bit better than some of the inconsistency we're seeing on the consumer side. Though again, going back to that last slide, in terms of what consumers are doing with their wallets, they still are spending, and then perhaps that's what's feeding back into manufacturing as well.
Yeah, so from here, Katie, we can slide forward. This comes then to, what are the actual companies saying? And this for us is kind of a read on real-time data in terms of what businesses are saying. And so company earnings announcements, during the earnings announcements for the prior quarter, most companies give some type of, update for the current quarter and what the outlook is going forward. So this is the question, right? Is this a cautionary tale, or is this the canary in the coal mine? And so this is back to the consumer. Retail, Walmart, Dollar General, even though we had that Walmart slide of same-store sales growth, Walmart's outlook for the entirety of 2025 is still growth, but slower growth than what they've had. That's indicative of where things like GDP are expected to come in for this year. These are all drivers of the underlying economy, which then should carry over into share prices or markets. Airlines last couple of weeks have warned about declining demand, that they don't have as much demand as they had. And I mentioned restaurant spending, and then the expected corporate activity. This was a big kind of part of that initial kind of Trump bump right after the election. Was there's going to be all this M&A activity and animal spirits and all of the like. And what has actually happened, aside from an announced deal yesterday of $30-some-odd billion by Google, which may or may not go through, but at least it was an announcement, is that CEOs right now seem to be kind of sitting on their hands and playing the waiting game to see where some of this stuff breaks out in terms of tariffs, how that could impact their business and businesses that they may be interested in buying or merging with. So we shall see.
Good. So maybe I'll jump back in here. So again, we've been talking about a lot of different things here in terms of policies changing, maybe some uncertainty, markets possibly slowing down, or seeing a little bit of an uptick, possibly in inflation and unemployment. So looking through that, let's take a look at what markets are telling us. Pretty kind of black and white here. We did see a move up in broader markets after the election. However, the recent move lower on rising uncertainty has brought us back to pre-election levels. And in general, we think investors are sending a message that they prefer to pay a lower price for equity ownership as long as uncertainty is increasing. So the question is, why is that? And with that, let's turn to the next slide. So we kind of step back and think about the people who are running the companies that we're investing in. How do these business leaders invest for the future when uncertainty increases? They might pull back on some long-term spending plans or delay a new product launch, something like that. If we go back to thinking about investors, perhaps as uncertainty is increasing, perhaps they take a risk-averse approach to allocations, maybe owning more defensive stocks, maybe owning more bonds or cash. Again, as we sort of think about this factor of uncertainty, we can even just bring it back to a personal level and think of a simple daily activity. So just many of us are here in the DMV, so we think about hitting traffic on the Beltway. How long do I have to sit in this? When will I get there? I was thinking about this as I was driving back from Tyson's over the bridge recently, and I started to get stressed out. And then, hit the button, Waze kicks in. It says 14 minutes to my destination. Okay, I felt my blood pressure start to come down. I was able to think a little bit less about traffic and think more about the rest of my day. In some ways, we are seeing some of this with policies, the economy and markets. Uncertainty just went up, but unfortunately, there's no sort of Waze app to tell us exactly what's happening next. However, we can rely on historical trends and some financial principles to help get us through this rough patch and stay on more of a path towards some long-term total returns. With that, let's take a look at the next slide. So what gets us comfortable with investing in the face of uncertainty here? Historically, we've seen corporate profits grow faster than inflation, and stocks generally chase those profits. So that's been a favorable trend. We can also benefit from diversifying our assets and rebalancing through cycles. As one example, we've done some of that this year, early in the quarter. We rebalanced some of our top equity holdings as stocks are trading in more elevated ranges. And finally, we can stay fully invested and avoid the pitfalls that can come with market timing, as we'll discuss on the next slide. So this is an updated version of a chart we've shown in the past. It suggests that even missing a few good days in the market can really torpedo long-term returns. And that supports the idea of remaining fully invested. Again, you can sort of take a look at just taking a few days out really has an impact. So with that, let's turn to how we're positioning amid the current uncertainty. Next slide. Okay, so we'll start with bonds. We continue to like high-quality bonds here that are paying interest rates that also exceed inflation, both for most corporate bonds and treasuries we're looking at. That does bring up a topic that many clients have, brought to us recently, which is, are treasuries safe? So as we're kind of looking at our positioning in general, as we look at treasuries, we do view them as the safest and most liquid asset around in general, especially in the bond market. We have high conviction that other types of bonds are generally riskier, especially outside the U.S. And the U.S. government has every incentive to protect the stability and credibility of treasuries. With that, let's take a look at what treasuries are offering these days on the next slide. So this goes back 10 years, takes a look at what 10-year treasuries are yielding. Right now, they're a little over 4.25. That compares to inflation around 3%. So you can see pretty attractive there. Bond yields are also attractive relative to most of the prior decade, which we see as favorable. So again, with that, still favoring high-quality bonds as far as positioning. And let's turn to the next slide to touch on equities. So with that, we have seen a correction and sort of some pros and cons out of that. On the more favorable side, valuations have come down to more reasonable levels. Certainly there is some uncertainty to be thinking about. But as we take a look at where our stocks trading, we can sort of quantify that on the next chart, move to 21. Okay, so we've got a PE ratio. This is price to earnings for the broader market, S&P 500. When things are up, investors tend to view stocks as expensive. When they go lower, they tend to view them as cheap. Stocks are still trading above averages, but they've come down from some of the kind of frothy levels we've seen recently. So we kind of broaden this conversation out outside the U.S. to look at global equities. We continue to favor U.S. markets over the rest of the world. That's because we have a view that we think U.S. companies can grow faster than their non-U.S. peers. This positioning has been pretty helpful for a number of years. However, we're seeing a pretty recent reversal. Frankly, it started last month, where rest of world stocks have outperformed. Now, why is that? A lot of that recent move has been on investor sentiment, with U.S. stocks getting cheaper and the rest of the world getting more expensive. Again, going back to the valuation chart we're looking at here, as opposed to fundamentals. In other words, we're not seeing U.S. company profits decline and rest of the world profits really spike up. With that in mind, we continue to view U.S. equities as attractive. However, we are open-minded. If we start to see any fundamental changes with U.S. company profits, let's say, growing more slowly or erratically than other markets, we'll certainly respond to that as we're looking at different allocations. Next slide, please. Okay, so as we wrap up here, we continue to evaluate scenarios for what's next as companies adapt to evolving policy and economic changes. We do expect profits to outpace inflation, especially for our core holdings, as they launch new products, gain market share, and improve profitability. And with these long-term total return goals in mind, we continue to recommend a fully invested allocation. So with that, we'll conclude our prepared remarks and turn to your questions. Back to you, Mike.
Great. Thanks, Mike. So we wanted to keep the prepared stuff to 20 or 25 minutes here so we could get into questions. Um, Katie, would you mind jumping back to, I think it was slide 18 or so, which is the right there. Yep, the 10-year, 19, sorry. Um, yeah. So we have a question here that I'm going to get to in a second, but I want to go back to something that Mike said about this because along the lines of the client questions around um, sanctity of pension income and things of that nature, whether it's Social Security or pensions, and the stability of that. This question around the stability of U.S. Treasuries, I think, is a really important one as well. Um, everything, every asset, okay, in terms of at least an income producing asset, be it real estate, commercial or residential, an equity, a stock, a bond, every asset is priced with a baseline of a risk-free rate, and that global risk-free rate is the U.S. Treasury bond and built a bond, depending on your timeline. And so, the market has not been, at least in terms of the fixed income market, while the stock market has been, much more volatile lately. The bond market has had some volatility, but nothing to the degree that would indicate some kind of, credit event or concern about the U.S. Treasury making good on its obligations. I think that's important for everybody to hear. While we're here, Claire asks, how are you thinking about persistence of the inverted yield curve? So there's a couple different, Claire, versions of that. There's the 2-10 spread, and then there's the three-month and 10-year spread. Both of those right now today are positive. So the inversion there has gone away, but it is accurate that the 2-10 spread in particular spent the better part of 2 years and 2 months in an inversion status. And for those on the call who don't know what that means you were being paid more for like a 2-year treasury or even a 3-month treasury there for a while than you were a 10-year. So as a lender to the treasury, why would you take the lower yield for a longer period of time? And that's usually a leading indicator of some economic distress. Again, that went negative midway through 2022. It's worth noting that 2022 was a year of economic distress where both stocks and bonds were down, excuse me. And in fact, the 60/40 portfolio through September of that year was down more than it was at the end of 2008. Then recovered a little bit in the fourth quarter. So that has historically been a signal predicated recessions in the past, though the timing mechanism behind it is not exactly fully reliable. Mike, do you have anything to add there?
Yeah, no, I think certainly a metric that we look at, you could even broaden that out to other metrics that folks have looked at in terms of trying to predict the next recession. Is it the bond market? Some folks have looked at the speed of increase of unemployment. If unemployment spikes very quickly, that can be an indicator. There's certainly some other ones, but these are things that we continue to look at. And then as far as asset allocation, looking at bond markets in particular, and still seeing yields as fairly attractive again versus history. So something worth watching.
Great, thank you. A question from Les. Seen recent discussions that foreign markets may be a better investment based on current direction of the U.S. market. Thoughts on this?
Sure, so we can jump on that. We sort of touched on that a couple minutes ago in terms of what we've seen. Again, this is just really a couple months with U.S. stocks sort of sentiment. How are people feeling about stocks declining? And then the reverse for international. So the question is, at what point does that go from a feeling or a sentiment to fundamentals, to companies really changing? I haven't seen that yet, so I think it's probably too early to tell. But again, if we look at sort of last 10 or 15 years or so, we have seen U.S. companies grow faster than the rest of the world. And the question is, could that change? It's certainly possible, especially tech companies have been growing very quickly. If there's a slowdown there, that's something to watch. So at this point, really don't see any major changes to that, but certainly plenty of high quality companies outside the U.S. and some of them are worth owning. But again, at this point, as we're thinking through, do you want to own a little more of the U.S. or less? We think that the U.S. is still more attractive.
Great, thanks, Mike. Mickey says, what is the inflation outlook? Do we expect the Fed to lower rates? And I know we had a slide on inflation, but I think this is also a good place in terms of the soft versus the hard data. One of that UMich sentiment things is, what do you think the outlook for inflation is? And that number recently in the recent survey hit something crazy, like the long range figure was like 4%. I think the near term was almost 5%. So that's the soft data. You want to spend a minute in terms of the hard data and then the Fed's expectations there, like.
Yeah, absolutely. So as we think about inflation and kind of expectations, there's a lot of pieces that kind of roll into that. But a lot of times, just consumers out there in the economy, if you see something, if we go back to 3 years ago now, 22, this is when supply chain problems were happening, prices were spiking, the consumer price index hit 9%, really pretty significant. A lot of people just buying things and sort of the broader feedback in terms of what does that inflation look like longer term. There's a little bit of a short-term bias there. So I think that when you're in sort of the eye of a storm, if you will, of really high inflation, a lot of people in markets think that that's going to remain high. However, sort of broadening that out, a lot of times that tends to fade or kind of revert back to a longer term mean. And that's sort of what we're looking at in general. However, in the very short term, we are starting to see expectations for inflation, especially at the Fed, tick up just a little bit, not dramatically, but somewhat. Tariffs are probably part of that, and other things that are feeding into price increases. So that's kind of where we're looking. But I think most investors expect longer term. You may not get back to pre-COVID levels of inflation, which were around 2%, but maybe somewhere between 2 and 3 over time.
Great, thanks. What's your view on Trump not ruling out recession and seemingly being okay with that? Connor asks. Maybe I'll tackle that. So I don't think that you can ever rule out recession. In any given year, there's typically a 15% or so probability of a recession at the beginning of a year. I wouldn't feel great feeling good about that. I don't think anybody's rooting for a recession, or at least I hope not. That wouldn't be great if that's the question. But I do think I think about maybe behind that, Connor, and then some other questions we're getting in terms of probabilities. If in a normal year the probability is 15%, what is the probability or the likelihood of recession now? And that, I think, is the secondary question behind that question is what could happen in the markets, right? And if the markets are down in a correction level, a week ago with the S&P down 10%, NASDAQ was down 13 or 14. Small cap Russell was just touching bear market status, almost down 20%, I think, at least intraday. So if you would slip into a recession, that would not be a correction type of 10 to 15% where you have some type of base forming and then climbing back. It would be the first 10 or 15% of X 10 or 15%. And that becomes the question. If you slip into recession, how far could stocks fall? And we typically, when clients come on board, we talk about this in terms of not just percentage points, but in dollar terms. If you had a 100% stock portfolio and you had $1 million and it was down 15%, you lost $150,000 in the near term. It's something you probably you wouldn't be happy about it, but expect to have to stomach for being 100% stock. If all of a sudden you lost $350,000 on that $1 million because we slipped into a recession, or even $500,000 of that $1 million, that's typically the gut check question around where your allocation should be. And that's, we don't know, but those are the things that we're watching, both the soft and the hard data, to see, where that may be. I think Powell's comments today were actually, fairly optimistic. The market liked the tone. I think it's worth noting the market was actually up twice the level of where it was when he started speaking or when they released the number at 2:00. So we shall see.
Maybe, Mike, if I could just jump in at one quick comment in terms of recession and stocks taking a hit. A lot of times, if you go back through history, there are a couple different ways to think about this. If there's a run-of-the-mill recession, it seems like it's never normal, but if it's just sort of a cycle, things get a little overheated in terms of inflation, comes back down, or there's just a wave of unemployment, that tends to be a more modest type of impact on markets. When I say modest, it could be down 20%, which doesn't feel good, but that's sort of the type of level. If it's more structural, for example, dot-com boom and bust, housing boom, et cetera, If there's some asset that's really overinflated, if that deflates, that can lead to a much bigger impact. At the moment, we're not really seeing that either in stocks or in other assets, but that's really worth watching as we think about kind of what's next for the economy and markets.
Right. Um, Anonymous attendee, what's your thinking on the use of puts to ensure against further equity market slide? Yeah, that is a strategy that you are welcome to employ. It's not the one that we employ here, using options to buy insurance effectively. That is something you can do. I just remind people every time they ask about options that those are designed for 99% of them to expire worthless every time you buy them. So not not just something worth noting, not something we do. Matt has a barbell approach to the questions here, and I think it's a great barbell. So here we go. How much of the portfolio should be in bonds at age 70? And what is your view of Tesla stock in the next 12 months? So, Matt, a good place to start on the bonds point is at least you know the old 100 minus your age is how much should be in stocks. The inverse of that's what should be in bonds. I will tell you the typical 70-year-old FPB client is not only 30% in stocks. They're probably closer to 50, 55% in stocks. If there ever were a time to have more in bonds over the last 20 years, now is arguably that time. Going back to the fixed income chart, that was the yield chart on bonds. So the opposite of the PE chart on stocks, where high is high. High for bonds is low. So high yield is lower price. So if there ever a time to own more bonds in the face of market uncertainty and being able to collect 4.5 to 5.5% coupons, now could very well be the time. And would encourage you to talk to your FBB portfolio manager or advisor about that. On the Tesla side, I'm gonna stay away from that politically, but I'll let you know that FBB is presently not in that name, which I think says what we think about it the next 12 months. So it remains, even with a 50% correction, the most expensive stock in the Mag 7 universe. So, okay. Going back to tariffs, current tariff volatility threats. Mike, I guess asking, handicap like what's maybe going to happen in the next few weeks between now and April 2nd and thereafter, and what the impact of 2025 market expectations could be.
Yeah, absolutely. So lots happening there in terms of tariffs, how it could impact the economy and markets, and things are unfolding very quickly. So it is really hard to handicap precisely what may happen. I think we can do a couple things. We can look at what's already happened, what tariffs are out there, what things the administration has talked about, what's they're talking about for next steps. There are a few other wrinkles here. So there are some new individuals coming in, a new U.S. trade representative. There may be some additional kind of structures around the way that the U.S. handles tariffs and maybe putting them in categories as opposed to doing more one-offs. So it's really difficult to see. As we think about, we're trying to figure out what does this really mean for the broader economy. So in general, the U.S. does tend to trade less than other big countries. So if there are tariff impacts, that would sort of hit the U.S. less so than some other countries out there that do a lot of importing and exporting. So that's sort of one issue. The other is, we've got a sort of proxy here. We've got the late teens when this happened, and certainly it was many of us lived through that. It certainly was not fun as we sort of looked at, here's this new round of tariffs. What's going to happen? It was very difficult for some pockets of companies. I'm thinking, washer and dryer type companies, sort of big equipment type things, or parts of Lowe's and Home Depot, big box type things where you have to import something. Definitely some pockets of severe pain. However, if you look at a broad portfolio of stocks, for example, companies, there are a lot of domestic companies, whether that's a services company or a utility or something like that, really don't have a whole lot of exposure. So we could see an impact. It could impact inflation, could impact the economy. But as we think through our portfolio as it's diversified, really would not expect a massive impact, more so than kind of what we saw the last go around, the late teens.
Great, thanks. Asif says FPB's prescribe a 60/40 equity portfolio for growth near retirement or currently retired investors. Is there anything we're changing with that? I think is the question in terms of, a good place to start, Mike, from an allocation standpoint.
Yeah, absolutely. So as we think through, someone who currently has a 60/40 allocation, I think for that individual, if nothing's really changed with their story, their plans, as we just look at the rest of the market, there's really not a whole lot we would want to change. We do view 60/40 as a very good place to start for a lot of folks. So that your overweight equities, your overweight risk assets, however, you got a big chunk of your allocation in relatively safe bonds that allows you to do a lot of rebalancing. So in general, that's not something we would look to make massive changes with, sort of generically. Although, again, on an individual basis, if something is changing for someone's situation, that certainly could be a moment to reevaluate.
All right. Yeah, I guess there's another comment here about, when is the timing to not be fully invested? There have been times where we've increased exposure to cash specifically, for example, or fully invested could be fully invested, but not equally in each asset class. So today, the recommendation is that you be fully invested in both sides of the asset allocation, both stocks and bonds. FPB's positioning for most clients over the last 15 years has been overweight to the equity side of that equation. And over the last year and a half, we've really started, trying to get people on board as the opportunity set within fixed income has given us a chance to get more normalized returns there instead of 2-3%, 4-5%. So I think I answered that question. A couple of questions around ETFs. We do own ETFs for for most clients, at least to some degree. ETFs are exchange traded funds, baskets of stocks and/or bonds that are indexes for certain things. In the fixed income side, think of high yield, a way to play that diversified. On the equity side, could be small cap, could be mid cap, could be a position in a large cap growth or even an S&P ETF for a portion of that. So yes, we do include those as part of their respective equity or fixed income within the portfolio. I had a client call me out on the Michigan jab because I'm wearing a blue suit and a maize tie. Thank you, Ken. Hat tip. Appreciate that. I've got a red pin here somewhere, scarlet pen. Okay. Yeah. But okay. So Alex asked about part of on policy uncertainty is fueled by a constant flow of new ideas, such as the Mar-a-Lago Accord. Some of these things, including that, could impact the Treasury market. Mike, I'll throw in the discussion of like a Bitcoin reserve and treasuries and what the impact there could be there. Not a lot of data there to make a call on, but something we're aware of. But please.
Yeah, again, it's a little bit of speculation here in terms of, could the Treasury do something, either with the value of the dollar, do something with crypto, or have a reserve coin or something. At this point, that's not sort of the top of our list of concerns or potential upside drivers. Certainly, as something looks more material or certain, we'll take a harder look at that. But I think in general, the focus, if we're looking at long-term investment total returns, sort of the risky portion of that is the equity piece, and sort of focusing on that, really looking at earnings. That's really been a main focus for us. And a big chunk of what we own tends to be more domestic. So if there's something going on with the dollar, that tends not to affect a lot of our companies with that domestic type of sales or earnings generation. I mean, but certainly worth watching as you have some things around the edges here that do impact, whether it's the dollar or some feedback into demand for treasuries, et cetera, worth watching. But again, it appears to be a little bit more speculation at this point.
Right. Linda asks, I want to be specific here. So Linda asks, what's the bond market telling us about market expectations? I kind of mentioned this with the Treasury. So the spreads have widened, right? So you have the US Treasury is the base rate, and then you have like investment grade corporates, then you have high yield bonds and anything that becomes more risky is a spread against that treasury. So spreads have widened a bit, but we're still not near average historical spreads. So it's when spreads, really kind of blow out that you start getting like above average types of spreads on asset classes where markets start to potentially freeze up a little bit. That happened for a couple days back in COVID, like almost 5 years ago to the day, March 18th to the 22nd. It was tough to get a bid on bonds for if you needed to get a bid. In the end, that was a good thing for those bond holders who weren't able to sell their bonds, because just by holding for like 2 more days, then like the markets, opened up. The Federal Reserve said we're going to provide liquidity, and they were able to sell those bonds at higher prices. So right now, nothing crazy in terms of spreads or bond market signals to what's happening in the stock market, or confirming a 10% stock market correction. Now, I would just say about the market correction, there's a lot of questions about the Trump administration and the government, the Doge, and how that's impacting markets and where it goes from here. I don't know where it goes from here, but I would just say, we expect, like, on average, a 10% correction in the market every calendar year. We haven't had one in 18 months. So what's been abnormal with the stock market is that there hasn't been volatility. There hasn't been a correction going back to October of 23. And before that, I'm pretty sure it was October of 22. So we haven't had that type of full drawdown. When it happens, did it happen fast? Was it quick? Was it a little bit jarring? Yeah, absolutely it was. But the other thing that you have to remember is with these markets, a lot of that is just kind of trigger selling based on machines having some type of equation that when the market hits this, sell, and when it hits this, buy. And so as an individual investor, we want to stay away from that as much as we can. We have a shopping list of things that we think we would like to own. Even this Michigan tie as an example, right? But only at a certain price. This was free, Ken. So only at a certain price am I going to buy this, and I'm going to wait until it's free or cheaper to do that. And so when you see these dislocations, or a correction and some dislocation around it, that's when you want to try to have some dry powder to then put some capital to work. And things that you want to own, not for 3 days or 3 weeks or 3 months, but for 3 to 5 years. That's the way we're thinking about it. Okay. Yeah, a couple questions, timely questions. Alex and Jay ask about European defense contractors. You want to talk about the disparity there in terms of what's happened in terms of returns there versus the U.S. Defense industry, Mike?
Absolutely. So we have seen a pretty big move for European defense companies. If you look globally, the U.S. companies tend to be a lot bigger. However, some of the European ones, in terms of what's going on outside the U.S., in Europe, and with Ukraine, Russia, et cetera, as investors expect the U.S., for example, to pull back somewhat in terms of funding and supporting Ukraine, we are seeing a bigger push for European countries to support some of their local defense manufacturers. And some of the investors are connecting the dots. We are starting to see those outperform. So again, certainly something out there. I think the question is, for long-term investors, is that a particular part of the global market that you want to participate in for a long amount of time, knowing that there could be some significant volatility versus owning more of a global defense company that's tend to be based in the U.S. They tend to have most of their revenue drivers from U.S. sources. So some pros and cons out there, but we're certainly keeping an eye on it. But it does appear to be a little bit more of a short cycle type of impact as far as some of the European defense companies outperforming.
Mike, going back to volatility a little bit, George asked a question that kind of ties into some of the stuff we are talking about. Given the volatility, what defensive moves in terms of positioning, specifically within equities, might we be making? Somebody else is asking about, dividend aristocrats, for example, but in terms of defensive positioning within stocks, or do we just buy companies based on their what we think are solid fundamentals, and consider the dips buying opportunities? So you want to talk about weighing those two things?
Yeah, absolutely. So, I think it's certainly a good question. As full-time investors, we have to be asking ourselves those questions all the time. And I think part of it is, so you could say, okay, well, so stocks have already had a correction. Defensive stocks have already outperformed. So the question is, if you decide now to make a bigger move, you're kind of buying a group that's actually gotten a little bit more expensive. So you have to be careful with that. I think there's frankly a mix. So we want to understand what's going on with the broader market. What are some bigger term trends? What sectors are doing better, worse? How are investors valuing them? At the big picture perspective, also looking, bottoms up. You could find a defensive or a growth or a cyclical company that looks very compelling, may have a very attractive valuation on its own, and that's something we want to go after. So it is a mix of both. At the moment, I think we are continuing to do both. We're continuing to look at stocks. Maybe on the flip side could be a growth or defensive name that's outperformed, and that's something maybe you want to trim and look at something else that's doing okay, or maybe it's looking a bit cheaper. So a lot of moving parts, but in general, making a big move into defensives at this point with these valuations, probably not the most likely thing for us to be doing.
All right, very good. Final question. Any change in thinking about cryptocurrency investing? I'll take that one, Mike. Negative, no change. These periods of market dislocation remind us that the areas, pockets of the market have speculation. Arguably, I would argue that nowhere is that speculation more rampant, maybe than the options market that somebody referenced earlier, but then in various aspects of the crypto markets. So that's not something that we are proactively helping clients buy. If they want to discuss it, we're happy to discuss it. We've got a few folks who then go out and execute on their own, which more power to them. That's what makes a market. All right, very good. Thank you to the 95 plus people who hung on through the duration of the call, and everyone that was on for any part of the call. That's all the questions we have today. Thanks for tuning in. Should you have any questions, we encourage you to reach out with our portfolio manager directly. We appreciate some feedback. We kind of pulled this together, as I said, a couple weeks short of when we would normally do it. So if you found it helpful to do something a little bit more on the fly, where we can get in front and talk about some of the volatility real time versus waiting the end of the quarter, that's great feedback. If you feel like you get some questions asked that maybe you wouldn't have asked on your own through having the group of other attendees ask questions, and you find that valuable, that would be good to know. If you don't find it valuable, that would be good to know as well. We appreciate it. We appreciate your trust and confidence in the firm always, especially during these areas of volatility. We do not take that lightly, particularly working with your money, your resources. And if you think that we should be talking to anyone else would benefit from speaking with us, given the volatility in the markets, we'd be happy to do that as well. So thank you, and goodbye.